Hi everyone, so today I'm going to do a video on LHX or L3Harris, which is a recent merger between L3 Technologies and Harris. This is a highly diversified defense company in America. They operate in a large different variety of markets, and I think at the moment they've got a very fair pricing for their future potential. So starting off here, we can see from the stats page, they've got a PE of 23.92, which is very similar to Lockheed Martin's and Northrop Grumman's. If we look at their yearly income statement here, we can see the revenues increasing. They've got a very low long-term debt ratio of 31.8% and a very good current ratio of 1.51. We can see that their total liabilities is actually decreased there. So moving on to what they do. So they have such a wide range of markets in the defence and aerospace sectors. So, for example, tactical comms, space control, avionics. Moving on to signals intelligence, satellite imaging, space communications. And this is one that really I think is a sort of developing market. So we've seen how much space affects our lives now, but moving forward, they're positioning themselves to be in such a good market for growth. This can be seen here from actually looking on Yahoo Finance. This isn't the definitive guide to investing, however, they've got a suspected next 5-year growth of 13.4%, which is slightly better than the past 5 years at 13%. The analyst, if you go off this, has a very strong rating to buy at 1.7. Looking at Seeking Alpha here, I've got a sort of portfolio of different companies within the same sort of region, same sort of sector. So we can see here it's some good news from L3Harris. We've got a sonar system order from NATO. We can see here if we look at the debt here, we can see they've got a very low debt to equity ratio for the industry at 34.7% here, which we addressed earlier, compared to RTX, which has 50%, all the way up to Lockheed Martin at 334%. If we look here at the value tab, we can see their price to earnings growth. So PE ratio over growth is very low, which is what you'd want to see. So a video I did actually cover was RTX. Surprisingly, has a very high PEG. However, I still think that company's underpriced. So this one has a PEG or PEG ratio of 1.08, which is very good. Only beaten by Northrop Grumman, and the other two are not shown. If we go on the company here, we can see for people who like to have dividends, we can see the dividend history has continuously grown for the last 17 years. So it's just continuously growing, which is what we want to see if you're a dividend investor and like to receive some cash back from your investments. So just having a brief look here at the financial health of the company. So this is another website I like to use, Simply Wall Street. Again, this is always good to do your own analysis, so looking at the balance sheet. However, we can see, as just discussed, the dividend is considered very good. The financial health of the company is very good, and we'll look through their balance sheet in just a second to see basically how it's performing. So compare this, say, to similar companies. General Dynamics has a very good dividend, and some others, that's just a pop-up. So we see earnings, this is just their basics. Earnings grew by 69.6%. Earnings are forecast to grow nearly 20% a year. Trading at 40% are below our estimated value, and it pays reliable dividends. So looking at the second quarter results here, what's a really key point, if we go to the initial summary, so revenue was 4.4 billion on Q2 of 2020, so up 138% compared to the previous year. Net income margin of 6.3%. So going down here to the financial results, we can see the revenue increase as discussed there, 138%, up from 1.8 billion to 4.4. And actually, if you look at the first half growth, so Q1, Q2 2019 compared to this year, it's actually grown 152%. So looking at some of their individual business segments, so this is not meaningful, the growth here, and it says it's not meaningful because its segment comprised entirely of the former L3 business. So if you go to a meaningful section, so space and airborne systems, so this is the business segment that I'm really excited about and the future growth. So we can see here that the Q2 from 2020 compared to 2019 grew 23%, and the first half grew 24%, with the operating income also growing 24%. So some of the significant actions here taken: $81 million to provide end-to-end mission control for a classified customer, a multi-billion-dollar competitive award for small satellites, so it's showing it's a growing industry, multi-million-dollar order for international customer for a large commercial space reflector. So looking at communication systems, this has grown rapidly, so 86% on the first half of the year 2019 versus 2020, and even despite coronavirus, it's grown 83% in Q2 from 2020 to 2019. So we can see here that they've had a $95 million award for third production order for the US Army's 12.7 billion HMS Manpack IDIQ. Let's have a Google what this is, I'm not actually sure. So it looks like some sort of radio pack. The aviation systems, this is another not meaningful, just previously former L3 business. So what is also very good is to see their large amount of cash flow. So we can see here from 2019 to 2020 they've had an increase of $491 million in cash flow and 518 in adjusted free cash flow. So this is all just very promising signs showing that they've been able to weather the storm. They've had increased revenue growth, and they've got a large amount of free cash at their disposal to help them through what is seen as quite a trying time. So that's just my opinion on L3Harris or LHX. If you have any thoughts, please let me know. I will be buying more of this company in the foreseeable future. I think it's a very good investment, and it's nice to see a growing dividend. So let me know your thoughts. Thank you very much.